Moving average is the most common trading indicator that most professional and beginner traders use. And trust me, most of them they still don't use it correctly. So in this video I'm going to focus on four main things. The first one, the basics behind moving average, how to use it to increase your win rate in your trading strategies, how to let your winners run and cut losses quickly with using moving average, and for the last one, spotting trend reversals. If you know me from the chat room, you know that I approach trading in an engineering way. So let's get into the math, how moving average works. So I drawed you a chart on the x-axis, the time frame, which is any kind of 1 minute, 30 minute or day, even daily, any time frame works. And on the y-axis, the stock price. And I drawed you a random chart, a random stock price chart. So on this chart, I'm going to plot the 5-period simple moving average line. Calculating an average, it's very simple. Let's take a class and we're going to calculate the average grade of the class, which is the average. You simply take all the grades and divide by the number of students. It's the same idea in trading with the simple moving average lines. So for the 5-period SMA line, we need to calculate on the last 5 candles the prices. So we divide by 5 and we start adding the values. At 4, it's 8. At 3, it's 4. At 2, it's 6. We add 6. At 1, it's 3. And at 0, it's 2. And we add the values, we get 23 over 5, which is 4.6. At 4, the price is exactly the 5-period moving average line is exactly 4.6. We add 4.6 and that's it. We can take another example at 7, which we're going to do exactly the same thing. We're going to take the average of the last 5 prices from 7. So we're taking the average of the last 5 candles, which is 36 over 5, and we'll get 7.2. And we plot 7.2 on the charts, we get another point on the 5-period SMA line for the stock price. I'm adding all the values together, and this is the 5-period SMA line for this stock price. It's exactly the same thing for other periods. For example, for 10-period SMA, we calculate the price of the last 10 candlesticks, which is exactly the same thing, but we'll get another chart. Now, you know that we have simple moving average and exponential moving average. In simple moving average, we give exactly the same weight as you can see here at 2, 3, 6, 4, and 8. We are giving exactly the same weight for each price at a specific time. But for an exponential moving average, we give more weight to the current price of the stock. This is the formula if you're interested. You don't need to understand in details how the formula works, but you simply need to understand that it only takes the value of the previous candle to tell you the value of the current candle. However, in simple moving average, as we explained previously, because it's an average, we take the average of the last candles. This is a chart example how it reacts more to the current price. As you can see here, it reacted more to the current price. A quick example on Apple, how moving average and exponential moving average is kind of different. In yellow, this is the 200 simple moving average, and in blue, it's the 200 exponential moving average. As you can see here, Apple is on an uptrend, and the 200 moving average have the same slope because it's an average of the last 200 candles. But exponential moving average, it reacted faster to the upward movement and it reacted faster to the downward movement because it reacts more to the current price. And same idea here, because Apple was on an amazing uptrend, exponential moving average followed the current price much more. Another great way to use the moving average is to catch momentum. Here's a perfect example how you can catch momentum using 200 moving average. You know from catching a momentum, the word catching a momentum, we clearly want to buy around when the price is close to 200 moving average or any moving average. Okay, so we're going to buy right around here, and we see perfectly how Apple is forming a higher high and a lower low. If you don't know what it means, higher high, lower low, it means that the stock price is going up. It formed a high and a low. What we mean by a higher high and a lower low is it formed a higher high, which is higher than here, and a lower low, it's here. This is what it means: higher high, lower low. It's a many traders using the following this price action using these terms. Okay, so if we were going to catch momentum on Apple, we would buy right around here, which is 75, which is around $75. Okay, and we're going our where we're going to cut losses, it's exactly here, which is the low of the lower low formation. Okay, so it's around here, which is around $72. If you subtract 75 to 72, it's $3, so you're risking $3. Where you need to take profits, it totally depends on your strategy. If you have around 2-to-1 risk reward ratio and you're risking 3, you need to take profit when it goes up $6. 76 plus 75 plus 6, it's $81. So if you take 81, which is yes, here, this is where you need to take profits. So if you got in here and your stop loss is here, if you're risking 1 to make 2, you need to take profits right around this area. Okay? And again, same idea. If you got in right here, catching the momentum around $87, here's another example to catch the momentum using 200 moving average. If you got in right here to catch the momentum, basically, your entry should be, if it's your if your entry is around $88, your stop loss should be at the exactly at the lower low formation, which is right here, which is around $86. Okay, so your entry is $88, your stop loss is 86, you're risking $2. If you're going to risk $2, again, totally depends on your strategy and how you think. If you're risking 1 to make 2, your taking profit area should be $4. If you're going to add $4 to 88, it's $92. So this is where you need to take profits for. And if you're going to make, if you want to make more profits, you can even use another moving average to ride the trend. So your target is $92, and a perfect way to maximize your profit is to use another moving average. For example, we used 50 moving average right here, and we're going to try to ride the trend using the moving average. As you can see here, the price is above 50 moving average, and this was our target. Where you need for example, if it reached target, you can take out 50% of your position, take your profit, and that's it. But if you want to ride even more the trend, you can use another moving average to ride a shorter term trend. If we stayed in the position as long as it's above 50 moving average, you can see you would get out right around this area, which you made even you risked 1 to make 5, so which is much more profits. So with this way you can use 200 moving average for a longer term trend and use another moving average like 50 or even 20, even 9 for intraday trading for a shorter term trend. As we used here 50 moving average to ride a trend using 30-minute time frame. Here's an example on a downtrend on American Airlines. We can do exactly the same thing, same process, everything. You can catch momentum using short position. Instead of buy, you can short the stock. So you could short right around here Where's your stop loss is at this higher high formation, where you need to take profits. It's around here, and you can use a shorter term trend like 50 moving average or 20 or anything to ride even more. So instead of taking full profits here, you can ride the trend even more using 50 moving average and get out probably here. As I always say, stock trading is a game of probability. So if you're trying to take long positions when a stock is on a downtrend, you're fighting the trend and you have less probability to win on that trade. Same idea if you're taking short position on an uptrend. You're basically reducing your win rate, the chance to win more. So this is exactly how I use moving average to increase my win rate and even my risk reward ratio by riding the trend. If you want more content like this, please make sure you subscribe. It takes no effort, just one click. I'm waiting. As promised in the beginning of the video, I'm going to focus on four things. The first one on the basics on moving average, how to let your winners run, and how to increase your win rate. So we've talked the three, and now we have the last one, which is how to spot trend reversals. Many traders, including me, we use two moving average to spot buy and sell signals. For example, I use 9 and 21 EMA for day trading and swing trading to spot sell signals or even buy signals. So, for example, in this swing trade on ANF, I set to cut losses when 9 EMA and 21 EMA they cross together. So my entry was at 19.01. Check here on the chart. My entry is at 19.01, which is here, and where I need to sell the stock when 9 EMA and 21 EMA they cross together. Why? Because when it crosses, it gives bearish sign, which is a sell signal. As you can see, we got in here at the breakout, and where's our sell signal? It's when 9 EMA and 21 EMA they cross together, which is here. So we got all this move, which is around 25%, without worrying when to sell. We could sell right around this area if 9 EMA and 21 EMA they cross together, which is a trend reversal. So this is how I try to maximize my profits using swing trades. This is on a 30-minute time frame, for example. By the way, all the strategies are available in Elite membership, which we have Discord. I send alerts and everything. You can find details in my website, mrstockflipper.com. Another huge winner was on Domo using moving average again. Without worrying where to sell, you can ride the trend using the moving average. So I set to buy at 57. I have a previous alert to buy earlier, which is at 46. As you can see, on this alert we bought at 57, and I set to ride the trend using 9 exponential moving average and 21 exponential moving average. So we bought here, and where we need to sell exactly at the trend reversal. Where's the trend reversal? It's when 9 EMA and 21 EMA cross. In interactive broker, you can there's a preset that you can use 9 EMA and 21 EMA, and even they will give you buy and sell signals, which is pretty cool. So we got in here, and without worrying where to sell, even if a small profit or big profit, you won't worry. You just sell whenever it crosses. You can even get short when they cross because it's a sign of trend reversal. After this huge 50% run, it can do a pullback. So that pullback, you can get in short. You would make money on the way up and money on the way down. So double the profit. So this is again how I use to spot trend reversals and get my buy or sell signals. Another way that I use the 9 and 21 exponential moving averages are for shorting intraday. So I try to find stocks that had pretty big run up and I try to short them. But how I short? Remember when I said I tried to find using 9 exponential moving average and 21 exponential moving average when they start to cross. We know that moving averages are a lagging indicator. They are not a leading indicator, they are lagging. So in intraday trading, I try to find this weakness in the price and I go short. So I was trying to explain why I went short on Roku. It had a pretty good run up, and I was trying to get short on the stock. Okay, I alerted short here. But why I alerted short? Because as you can see, 9 exponential moving average and 21 exponential moving average, they start to cross, which are they are closing the gap between them. When I find this kind of opportunities when a stock had a pretty good run up, I find this as a shorting opportunity, which you can do the same thing with long, right around here. Because of moving averages are a lagging indicator, I try to expect a cross. Because of moving averages are a lagging indicator, they are not leading like MACD or RSI. In intraday trading, not swing trading, I try to get in before the cross. As I explained, when 9 EMA and 21 EMA they start to close the gap, it's a losing momentum meaning, which I try to go long or short before the cross, because sometimes when the moving average cross, we're already late. So I try to expect a cross using the moving average. So for the last example on using the moving average is on OXY. OXY had a great run up and I was long in the beginning, and using the 9 EMA and 21 EMA I got all this move which I made pretty good profit, but at the end no stock will go in a straight line upward. I tried to find a reversal opportunity. How? As I mentioned previously, when 9 EMA and 21 EMA they start to close the gap between them, which is a reversal sign. So after going short using the moving average, I tried to ride the trend again using the moving average, which using the 21 moving average, as long as it stayed below 21 moving average, the stock price, I stayed in my position. And when I got out from the position, right around here, when the price crossed with 21 EMA. So as you can see, you can make huge profits and riding the trend using the moving average. Thanks for watching. I'm going to regularly upload contents like this, so make sure you subscribe so you never miss a video like this.